of 2026, and we are diving into a series of webinars that we'll cover today and over the next 3 webinars. We're going to be tackling the idea of the asset class cycle and the different asset classes that make it up. Today is just meant to be an introduction, a sampler of what we're going to cover over the next 3 webinars, and is a great opportunity for us to talk about why any of this matters in the first place and address any questions that you all might have right away. Without any further ado, let's get right into it. Quick disclaimer, we're going to talk today about different types of investments and an idea of an overall trend. Please remember, what we're going to talk about is something that we will see in a textbook. Reality is not like a textbook, for better and for worse. And that means that past results cannot guarantee future performance. The asset class cycle is real, but it's not like a calendar that every February comes once every 12 months. It comes and it goes, it moves forward and it moves backward. And that's why it's very important that what we take from today isn't these are the recommendations on what to buy. Instead, we learn the reasons why these different investments will perform better or worse during periods of the asset class cycle, and allows us to make more informed investment decisions. So today we are talking about asset classes. So we're going to talk about what asset classes are and what the asset class cycle is, the 4 different types of assets that make up the cycle, and a few that we can talk about and then shove to the side. Then we're going to go into why any of this matters in the first place. Why do we care about different asset classes? And more importantly, why do investors care about different asset classes? Excuse me. Then we're going to talk about the reason or reasons that this cycle exists and what pushes it forward, and then compare the asset class cycle to other cycles or rotations that we might be familiar with, mainly the market and economic cycles. We're also going to cover how these different, we'll also talk about where we go from here, because like I mentioned, today is just an introduction. We will go into more detail about these different asset classes over the next 3 webinars. So we're going to mention how we'll actually tackle those, and then give you a preview of what we'll cover in each one of those webinars. Sound good? Let's do it. First, let's start off very basic. What is an asset class in the first place? Well, let's take the word asset. It's just another name for an investment. An asset is anything that we have, could buy, could own, and could sell that has value, and that value could go up or down over time. So in reality, my phone is an asset, a house is an asset, anything that has value and can be bought or sold technically would be an asset. But what we mostly care about are the investment assets. And the asset class is just the specific type of investment. So I wouldn't say a Samsung S25, I think this is. No, I would say a phone. Phone would be the asset class, or smartphone would be the asset class. But an easier way to think about it is to think about asset classes like sectors. We have technology, discretionary, communications, utilities, energy, and so on. And what that is it's a way of grouping companies together based on what they do. Another way to say that is classes. We are creating different classes of stocks based on what they do. So one class could be technology, another discretionary, communications. You get the idea. So an asset class is just a way of grouping similar investments together. And the reason we do that is because things within that group tend to move up and down in price or return together for similar reasons. So we could look, for example, at AMD and Nvidia. Typically, those two companies are going to move up and down in price in the same direction because they're both semiconductor companies, and what affects one will probably affect the other. But just like with sectors, certain classes will do better or worse than others during certain periods of time. That's the whole idea of market sector rotation. During periods of growth or early recovery, we'll see technology and discretionary communications perform well. As the economy begins to turn and the stock market begins to go down, defensive sectors like healthcare, staples, and utilities will typically perform the best. That is the idea of sector rotation. This is going to be very similar, but instead of 11 sectors, we have 4 asset classes. These 4 main asset classes are not the only ones, but they're the 4 that are most commonly used when we're talking about things that we will actually invest in. The first one we are all familiar with, so let's start off easy. Stocks, also called securities or equities. This is buying a piece of a company. You buy a share of Tesla, you now own a piece of Tesla. When Tesla's value goes up, the share price, that share that you own, goes up in price as well. And typically, prices of stocks go up and down based on the company's growth or their earnings. The second one is bonds, also called fixed income or debt securities. These are, for the lack of a better term, financial IOUs. Somebody's borrowing money or somebody's lending money, and they are going to make a profit. And typically, returns here go up and down based on interest rates. Now, I want to pay attention to something very important here, because this will matter later on. Stocks. I mentioned that the prices go up and down. That's very important because a stock's price will go up and will go down. A share could be worth $100 today and $95 tomorrow. We have lost $5 of value. Bonds work slightly different. There will be an interest rate that bond gives, let's say 5% interest. That bond will give 5% interest. Compare that to a bond that gives 2% interest or 8% interest. We're not talking about the return of the bond being negative. We're just saying that the interest rate will be higher or lower. That is the return. So a bond won't really go up and down in price like we can think of with stocks. The main thing that will change is the interest rates. Are the interest rates or the return going up or down? Then we have commodities. Commodities are raw materials, stuff, things. I know we all like to invest in things and stuff. This is the opportunity. Commodities are buying and selling raw materials, hopefully not directly, because I don't know about you. I don't really feel like having 16 barrels of oil sitting in my backyard. If you have 16 barrels of oil sitting in your backyard, more power to you. But commodities are another asset class that many investors will consider and will invest in mostly indirectly. And here, once again, we've gone back to prices. The price of commodities will go up and down, mostly based on supply and demand. When there is low supply or high demand, prices will go up. When there's high supply and low demand, prices will go down. And lastly, inflation-sensitive securities. The most common example here are TIPS, Treasury Inflation Protected Securities. This is something that I've covered in a past webinar, but is going to be covered in plenty more detail over the next few weeks. Here, once again, we've gone back to returns. These TIPS are going to provide an interest rate, and that interest rate / return will go up and down based on inflation. So let's quickly review. We have the 4 asset classes. Stocks, the price will go up and down based on company growth and earnings. Commodities, the prices will go up and down based on the supply and demand of those goods. Both of those are the price goes up and down. Bonds and inflation-sensitive securities, they are using return, interest rates. So there, the thing that's going up and down is the interest rate it provides. Higher or lower interest rates, not really the... And I'm going to just put quotes around that because we have to talk here about we are just buying... We're talking about buying a bond. We're talking about buying a TIPS. We're not talking about buying an ETF that trades that type of thing. We will cover ETFs in the individual webinars, but it's a lot easier for us to think about the yield, the percent interest going up or down. The reason the price of the ETF goes up and down, we'll get to in another day. So that is an overview of the 4 asset classes. And I understand that some of this might be a little wonky. So if you have any questions and you're here live, feel free to ask. But in the meantime, I'm going to mention the fact that there are other asset classes, but we're not really going to talk about it. I'll give you a couple of reasons why. The first one is good old cash, dollar bills, or what are known as treasury bills or T-bills. The reason? They are short-term. In the case of cash, it's cash. It is not invested in anything except for the paper that it's printed on. And the fact that it's probably worth $5, $20, $100. That is not an investment. That's just cash. There's no return on it. And technically, it's losing value because inflation is a thing. The second one are T-bills. T-bills are debt securities from the Treasury Department that are less than 1 year. So they will mature in less than 1 year, and they don't work the same way as bonds or other longer term periods. So they have their own rules and their own ways that they generate profit. They don't really fall into this asset class cycle. Too short term. Not really long-term investment. The next one, real estate. If you were with us for our webinar last week, both in the Tuesday webinar and SM Espanol on Thursday, we talked about real estate and REITs, real estate investment trusts. The thing is, REITs are very diverse. And as I mentioned in my webinar on Tuesday, and my mom mentioned as well, they kind of have a life of their own. They have a cycle of their own. They don't really just exist in one small part of this asset class cycle. So if you want to get a full picture of that, please go and watch our REIT webinar from February 24th of 2026. I believe it's just titled REITs. and the SM Español from Thursday, February 26th, also covering REITs. Then we have crypto. I have my personal opinions of crypto, and I'll tell you, they're not very positive. Is crypto an investment? Yes. Is it an asset class? Yes. The thing is, the prices kind of go up and down randomly. There will be good reasons why crypto is going up and good reasons why crypto is going down, but more often than not, it's going up and down for reasons well beyond our understanding or our ability to predict. It's not a company. It's not a barrel of oil. It's not the guarantee from the Treasury of the United States. It's some ones and zeros on a computer that have value because someone else is willing to pay for it. If that gives you an indication of my opinion of crypto. Do you invest in crypto? Awesome. There are amazing opportunities there. Personally, more risk than I personally like. In a similar vein, we have Forex or currencies. This is trading the comparisons between the dollar and other currencies, or other currencies compared to other currencies. Here, prices will go up and down due to global events and changes that exist outside of the traditional market and economic cycles. While yes, if one economy is about to go through a recession and another economy is growing, there will be a big shift in the Forex exchange between those two countries or their two currencies. That's not really about the market, economic, asset class cycles of the United States. So we'll avoid all of those. Again, all of these are great investments, or can be great investments, but they don't really fall into the traditional asset class cycle. So we're only going to focus on the big four: stocks, tips, commodities, and bonds. But why does any of this matter? Why should we learn about any of this? I'll give you a couple of reasons. The first one is the magic word in the world of investing: diversification. Don't put all your eggs in one basket. Very often, investors will try and put money outside of stocks or equities. They will try and invest money outside of the United States, maybe, but very often they'll try and invest it outside of the stock market. So knowing about these different asset classes gives us a way of knowing what other choices there are and an idea of what asset classes might be the leaders in the near future. That's the real important. The second one, alternatives. If all we're thinking about is the stock market, guess what? The stock market's going to go up in a bull market, it's going to stop, and then it's going to go down in a bear market. That's the cycle. It's going to go up and down and up and down. And we can either be along for the entire ride or realize that other asset classes are out there that can give us choices to help generate some returns and profits when the market's going down. Or, going back to point number one, help minimize or offset some losses that we have from the stock market. The final one is awareness. You don't know what you don't know. Silly example, but by learning about asset classes, we learn new ideas and terms that we're going to see in other places. For example, if we think back to last year in April, when all of the Liberation Day tariffs were announced, one of the big reasons that investors think the pause was put in place was because the bond market was starting to collapse. you don't know what the bond market is or why the bond market matters, that doesn't make sense. So learning about what bonds are and the role that they have is very important. Learning about what tips are is very important. When you see the prices of oil going up, when you see the prices of oil going negative, things like that are major news. And through learning about these asset classes, not only do we learn that we can invest in them, but when we see news about bonds or barrels of oil, we understand what those are and why they matter. So, a couple good reasons why we should learn about asset classes. But now, let's start to put it all together and talk about the asset class cycle. We care about these four main asset classes for a very good reason. They follow a semi-predictable cycle. And the reason I say semi-predictable is that it's not just this very clean cycle that constantly is happening over the same period of time. Growth will last longer than contraction. Expansion lasts longer than recession. But also, these asset classes, the cycle can go forwards and backwards. So it's very valuable to know that these four asset classes, just like sectors, will tend to move in a somewhat predictable way. And we call that the asset class cycle. Some assets will go up and down in price, stocks, commodities. Some will go up and down in return, tips, and bonds. Regardless of where the profits are coming from, the answer is the same. By learning about these asset classes, we can figure out during what parts of this cycle we would expect one or two of these asset classes to be the leaders. Think about it like sector rotation. Let's figure out, how does this cycle compare to the market and economic cycles? The answer, they're actually connected. We don't need to learn some crazy new idea that's going to make us have to forget everything we knew about the market cycle or the economic cycle. Let me show you. The market and economic cycles are connected. The market cycle on this graphic is in orange. During this period, stocks will go through bull markets, prices going up, and bear market, prices going down. And the one thing this picture doesn't show is that it's not this very clean line. The growth lasts a lot longer than the down. And typically, we will have more growth than we will lose during a recession or a bear market. The stock market has historically trended positive over time, has spent more time in bull markets than bear markets, and with, I believe, one exception or two exceptions, the bull market has always recovered the losses from the previous bear market and created new highs. So we have the market bottom, bull market, top, and then bear market. In blue, we have the economic cycle. This economic cycle is similar to the market cycle, but here we're looking at expansions and recessions. We have expansion where it's going up, a peak, recession with it going down, and we have economic bottom. Just like with the market cycle, expansions last longer than recessions, and historically, in many cases, I don't have a specific number, so in many cases, the expansions will grow beyond where the previous recessions ended. So we have these two cycles. And something that this graphic isn't showing, well, actually, I'll show that in a second. These two cycles they exist for a reason. They are real, and they are something that is always happening underneath all of the news and events and AI kind of stuff. These cycles are connected, where the market cycle leads the economic cycle. The orange comes before the blue. So the market hits a top before the economy does. By the time the economy's hit a top, the market is already going down. And on average, these cycles last 5 years. In reality, usually somewhere between 2 and 10 years. And the thing that is not included in that picture, if I remove the cropping, come back. Is that sectors sit underneath it all. During different parts of these cycles, we can expect certain sectors to be performing better than others. Full recession, during this period, companies have been sold off quite a bit, share prices are low, and companies can borrow money for cheap. Companies that want growth, need money to grow, they're the ones that are going to start to grow first. Technology, discretionary communication services, sensitive sector. Then, as business is starting to grow, things are looking pretty good. Now, industries such as industrials and materials will start to do very well because companies are expanding and require materials and new construction to expand. Here, we start to hit the market top, and the economy is beginning to slow down once again. Then, as the stock market begins to turn down, the first sectors to see losses will be those sensitive sectors, technology, discretionary communication services. Their growth has slowed, and guess what? We like those companies because we think they're going to continue to grow quickly in the future. The minute that growth is questioned, their share prices drop. I don't think we're expecting Costco to triple their revenue in the next year. But we might expect that of Nvidia. We might expect that of insert other growth technology company here. So as things start to turn downward, the sectors that will perform the best or be the least impacted will be defensive sectors that tend to be more value-oriented. Staples, healthcare, and utilities. As the economy is entering a recession, we start to see interest rates begin to go down. And as the interest rates are going down, interest rate sensitive sectors such as financials and real estate begin to perform the best. For the whole cycle repeats when interest rates are hitting their bottom, money's cheap to borrow, and expansion starts once again. The reason I'm sharing that with you is the idea that during different parts of this cycle, certain types of investments will do better and worse. Here, we're seeing it with market sectors. What we will cover is how the exact same thing happens, but with asset classes instead of sector. But before we get to that, let's answer a big question. The orange cycle, the market cycle, leads the economic cycle, the blue cycle. Why? What is the reason that the market leads the economy? Couple good answers. Starting off with the most obvious one, no one wants to lose money. We invest in our investments because we want to make money. We want to grow our value over time. And we're not alone. Investors will price stocks based on much more than just what they are currently worth. There's a reason that price to earnings is a thing. It's the idea that right now in the stock market, in the S&P 500, on average, you have to pay $30 for $1 of company earnings. Current value, just napkin math here, $1. What we think it could be worth in the future, $30. That's what that means. So the thing is, if investors are scared, if they think the economy is about to start slowing down, they're going to look around and say, oh, if this growth starts to slow, share prices are going to drop. I don't want to get stuck holding stocks going down, do you? There's a reason we talk about trailing stops. This is probably where trailing stops are going to start to get hit. Your trailing stop gets hit, you start looking around, and the stock market is mostly entirely red. Companies across the board are going down, buy is down 10%. We're trying to figure out where we put our money. Chances are, investors that know about different asset classes have probably moved them outside of stocks and are now holding something else. The other reason is economic data is slow. When we learn about the economy, when we learn about unemployment, inflation, GDP, gross domestic production, those take a while to get to us. And unfortunately, there's no magic "you are here" marker for the economy. Most of the time, we are not going to say we are now in a recession the minute it happens. Typically, we're going to look backwards and see, oh, we've been in a recession for 2 months now. Usually, economic indicators that we use are anywhere from weeks to months delayed. Let me show you an example. One of the websites I really like to use for economic data is tradingeconomics.com. We go here and we go to countries, the United States. Let's look at what economic releases we're getting this week. We're getting mortgage rates for February 27th. Services Purchasing Managers Index for February. Let's find the big ones, shall we? Unemployment rate. Oh, hey, that sounds like we would want to know that for February. And that's in March. We've got housing starts from January, building permits from January, PCE inflation month over month, how January compares to February, job openings for January. These data points are old, but it's the best we have. So very rarely can we say we are here in the economy right now. Usually, what we're looking at, the numbers that we're looking at, happened a while ago. It's like getting a birthday invitation, and for some reason it got lost in the mail, and it shows up 4 days after the birthday actually happened. So, the market cycle tends to lead the economic cycle because we don't know where we are in the economic cycle. But one thing is for sure, investors don't want to get stuck holding the bag. They are going to sell out earlier so they can take their gains and put them in a different type of investment. So, where does the idea of asset classes, where does the asset class cycle come in? Because remember, asset classes are more than just stocks. They're bonds, they're debt securities, they're things, they're oil, they're cows. Where do those come into this? Well, usually the asset class cycle is going to use the economic cycle. We will think about it in terms of where we are in the economic cycle. The reason we don't use the stock market cycle is the stock market is for stocks. The economic cycle is for the economy. So it's a lot easier for us to think about it like that. So let's use the economic cycle. If we go back for a second, it's the blue. We're going to think about this blue cycle. During different stages of the economic cycle, certain types of assets, asset classes, will do better or worse than others. Remember, some are price. The prices will go up and down. We will make or lose money. Others, they're only returns. We will make more or less return. So let's dive into this idea in a little bit more detail and cover some of the reasons behind why certain asset classes do better or worse than others wherever we are in that cycle. To try and make seeing a lot of this easier, I'm going to be pulling out some resources and charts from an institute called Pring-Turner. They have quite a few very interesting ideas and have created this 6-stage cycle for the economic, or what they call the business cycle. If you're interested, and I do want to give them fair credit, their website is pringturner.com. So when we're looking at the graphics on these next couple of slides, those slides or those graphics or pictures are coming from. The first thing I want to talk about, inflation. There's the stock market cycle, economic cycle, and the inflation and interest rate cycle. Now, before you just close your laptop and throw it out the window, I promise you we don't need to worry too much about this. The only reason why I mention it, many asset classes, stocks included, are sensitive or are affected by changes in inflation and interest rates. Stocks tend to move before the economy, and the economy tends to move before interest rates. If you've been a part of any of the webinars where I've talked about the Federal Reserve, you should know this pretty well. The Federal Reserve sets federal interest rates. They will try and increase interest rates to bring inflation down. And I should mention, inflation and interest rates here are not the same. We see this green cycle going up and down. It's not inflation goes up, interest rates go up. They are similar, but one fights the other. When interest rates go up, inflation goes down. When interest rates go down, inflation goes up. Now you never need to think about the inflation or interest rate cycle again. All we need to think about is this idea that during different parts of the economic cycle, contraction/recession, and expansion, certain types of investments will do better or worse. Pring-Turner breaks this down into 6 different parts. And it's a way of looking at this that I personally really like. On the right, we can see a graphic, or I guess it's above me here. We can see a graphic with those 6 different stages. 3 of the stages are in contraction. 3 of them are in expansion. Now, there's one thing I want to mention here. Audience participation time. Where in this cycle would you say that momentum starts to go up? What stage do we start to see momentum going up? Acceleration going up? 1, 2, 3, 4, 5, or 6? The answer is 1. Yes, it is still going down, but it's not going down as quickly. It's starting to slow down. it hits a bottom, and the momentum's the same, but now we're pushing it forward. Think about it like you have a little boat, and you push the boat on some water. And at the other end, you're sitting there trying to blow to get the boat to go the other way. For a little while, the boat's still going to be moving towards you until finally it stops and starts to go in the opposite direction. Stage 1 is where that happens. Here, we're already trying to push the economy back into the green, back positive. But it takes a little while for it to stop going down and to start going up. Then once we're in the green, the economic expansion, we're blowing in the opposite direction. That growth is slowing down, stops, and then goes the other direction. The colors at the bottom, that explains the colors at the top. It is the idea that during contraction, we are negative, but we're pushing things positive. Expansion, we are positive, but the push is negative. And below this chart, what we see are some green and red boxes. These just tell us during which stages, on average, different types of investments will perform the best. So for example, bonds perform the best during stages 1, 2, and 3. Stocks, 2, 3, and 4. Inflation sensitive, which here is TIPS and commodities, 3, 4, and 5. And nothing in 6. Interesting, right? Let's dive into all 6 of these sections. For each one, we'll explain what's happening, what's going on in the world, and reasons behind buying or selling specific asset classes. This is the asset class cycle. Let's start from stage 1 and work our way. We start off with early contraction or recession. The economy is declining, but as I mentioned before, how quickly it's going down is starting to slow down. Inflation is beginning to go down, and interest rates are close to or at their highest level. During this period, the stock market's still going down. And the best performing investment here in a traditional economic cycle: bonds. The reason? Interest rates are high. Money is expensive to borrow. So guess what happens when you are the one lending someone else the money? Because ultimately, that's what a bond is. You are lending the government, you are lending a company money. If money is expensive to borrow, guess what? Those interest rates are going to be a lot higher. So you get those interest rates. And here's the interesting part. Interesting? I promise I didn't try and do that one. Bonds mostly have fixed interest rates, which means if you get a bond that provides 7% interest for a 10-year bond, that's 7% interest for the next 10 years, or the duration of the bond. It doesn't matter if interest rates all of a sudden go down, your rate is probably stuck at 7%. So, interest rates are high, which means bond rates are high. You could buy into a bond, get that fixed high interest rate, and then when interest rates begin to fall, more profit for you. Then, stage 2, mid-contraction / economic bottom. The economy has hit the bottom. We know what the worst is, and we're there. And we're starting to change direction. Growth is beginning to start again, because inflation is pretty dang low and interest rates are easing up. Interest rates are starting to go down. During this period, we'll see the stock market start to recover. Let's think back. Here, we are starting to enter this bottom section of the blue line. The stock market is on its way up. So, what that means, stocks are probably the best investment during this period. Share prices are near their lows, and now money is cheap to borrow. So companies can start to grow, and that results in raising stock prices. Again, sensitive sectors will be the first to show growth and will often have the most growth. And this is where our idea of the market cycle can come in. We are able to find stocks that are cheap for what they are, companies that we believe can grow over time, or even value companies have been discounted because of the fact that the entire stock market's going down. When we look at the market cycle, it's not saying during a bear market, staples, healthcare, and utilities are going up. It's just saying that they might be going up, or they're just not going down as much as the other sectors are. They're performing the best, but relative strength is not the same as absolute price change or performance. That's why it's always important when we're doing relative strength to think about the actual prices of these shares, ETFs, or sectors as well. But going back here, stocks, once the economy has hit bottom, means the stock market is already recovering, and that makes it a really great opportunity to buy shares for cheap and ride out the entire bull market. Then we enter stage 3. This is late contraction or economic recovery. As the name says, the economy is starting to recover. Growth is accelerating, and inflation is low. We dealt with inflation, we paid the consequences, we had a recession, we're now coming out of it. Interest rates are going down because they're not needed anymore. Inflation's been dealt with. Let's let companies grow once again. Here, the stock market is firmly in a bull market. And the best performing investment in a traditional cycle would be TIPS commodities, those inflation sensitive securities. The reason? These are investments that will perform well as inflation begins to rise once again. Because it's not if, it's when. These cycles can speed up, slow down, go forward, go backwards a little bit. But they're always happening. The reason we can talk about these cycles is because they are always happening and they are inevitable. So what comes next? Well, we're now into stage 4, expansions. The economy is rapidly growing, but that growth is starting to slow down slightly. Inflation is starting to creep back up, which is why those inflation-sensitive investments were picked up during stage 3. And that means that interest rates may start to increase. The Federal Reserve doesn't want to let inflation grow out of control, so they might start to increase rates. Here, the stock market is reaching its peak. It's almost at its highest point. And the best performing investment now isn't buying anything, it's selling out of our bonds. The reason? As inflation rises, the return of bonds will begin to decrease. Think about it like this. If inflation is 6%, and we have a bond that's 7%, That's 1% profit. All of a sudden, inflation drops to 2%. Our bond is still 7%. So now we have a profit of 5%. As inflation starts to rise, our profit's starting to go smaller and smaller and smaller. And it's possible that inflation goes above how much the bond was giving us. Is a 7% bond realistic? No, that's pretty darn high. Let's go actually look at the 30-year yield treasury right now. Current interest rate is 4.7%. If inflation all of a sudden goes above 4.7%, we're not losing money technically, but we are. The amount of gain that we're getting from these bonds is lower than inflation. So, as the profit that we can get from these bonds is going away, we want to sell out before that profit gets too small. Then we enter stage 5, mid-expansion / economic peak. We're at our highest point. The economy is the best it's ever been, but it's already the growth has stopped. This is the top. And we know, as anyone that's ever been on a roller coaster, you stop at the very top for a moment, appreciate how high you are right now, and realize that there's one direction to go. Down. Inflation during this period is increasing, and interest rates are starting to raise to fight that inflation. And during this period, the stock market is beginning to decline. Why? Investors want to start getting out of stocks because they think the market is going to go down, because they think a recession is coming up. So, unsurprisingly, the stock market's beginning to go down because investors are starting to sell stocks, which leads to more investors selling stocks, and that's how a bear market begins. So, with the market cycle leading the economic cycle, when stocks begin to decline, we're also going to see company profits slow due to interest rates and high costs. Companies are thinking about laying people off or cutting spending or providing negative EPS guidance. Bunch of crazy ways to say sell. And then finally, stage 6, late expansion and slowdown. The economy is beginning to decline, and companies are cutting costs significantly. This is where we will see company layoffs happening. This is where we will see companies cutting back on their spending almost entirely. And inflation is still going up. We're still dealing with rising inflation, and interest rates are hitting their highest points to try and stop that inflation. Here, the stock market is well on its way to a bear market. But we had already sold out in the previous stage. And here, the best performing investment is selling out of those treasury inflation protected securities and commodities. When the economy is slowing down, commodities aren't going to do very well because they're tied to economic activity. It's not this positive or negative, it's not this higher or lower interest rate. These are prices, and the price can go up or the price can go down. So if all of a sudden demand slows because companies aren't producing as much stuff, because people aren't buying as much stuff, and costs are rising, money's more expensive to borrow, all of that throws in to say commodities are going to be going down, and we'd want to sell out of them. Tips start to decline because investors are trying to move money out of these safer places. They want to hold cash and prepare for the start of the cycle once again. Because now, the whole cycle starts over and we go back to stage 1. With all of that said, let's quickly revisit this chart. First, it would be bonds, as we see us starting to, as growth begins, but we're still on our way down. Interest rates are high, which means bond yields are high. Buy low, sell high for stocks. Stage 2, stocks are low, we would buy into stocks. Economic growth is beginning, which means inflation is starting to creep up once again. Here's where we would buy inflation-sensitive securities. And as that growth slows down, the economy hits a peak and dips. Here, we're selling out of, those 3 investments one at a time. First bonds, then stocks, then inflation-sensitive. And as we see below, during stage 6, there is no green. We are not looking at, oh, bonds are all of a sudden good now. Typically, stage 6 is sitting on cash. But let me quickly remind us, this is a picture on a textbook. In reality, it doesn't really look like this. This decline part is a lot smaller and a lot shorter than the expansion. The expansion is both longer and bigger, which means we have a lot more time to enjoy the buy stocks and buy inflation-sensitive securities part. Not as much time worrying about the selling inflation-sensitive and the waiting to buy bonds. Stage 6 to stage 1 happens pretty quick. But if your head's starting to spin, or this seems like a lot, or you're wondering the bigger question, cool, great, glad I learned all this, what do I do about it? Remember, today is just an introduction. It is meant to be, hey, asset classes exist. The economic cycle and the asset class cycle exist. Let's learn about them. So you might be asking how to invest in bonds, or what a TIPS is. Don't worry, we'll cover all of that. Today was just meant to be an introduction, and the idea that these different asset classes follow a cycle. Also, that cycle isn't some crazy new idea. It fits in really well to the market and economic cycles that we've studied and understood from the past. So where do we go from here? The next 3 webinars will tell us. For the remainder of March, we will have 3 more webinars, and as a heads up, these webinars will be recorded. I will be gone, which means that these webinars will be here to keep you company while I'm gone. From the way that you see things, everything will be exactly the same. Each one of these webinars will go live at 4 p.m. Pacific on Tuesday, the same time as our normal webinar. They will be done as a YouTube premiere, which means there will be the live chat and the opportunity to continue talking and enjoying these webinars just like you are right now. And in each one of those webinars, we'll cover one of the new asset classes. I don't think we need one on stocks. March 10th will be bonds. March 17th will be commodities. And March 24th will be tips. With all of those, we will have people in chat to help answer your questions and join in on the fun conversations. And as a note, for everyone joining for the SM Español webinars, those won't change. They will continue to be live on Zoom every Thursday. Voy a repetir esto en español. Durante el mes de marzo, vamos a tener grabaciones en el plazo de nuestros webinars. Pero los webinars van a estar casi los webinars usualmente. Vamos a tener una empieza del webinar a las 4 horas de Los Ángeles, 7 horas de Nueva York. Y vamos a estar en vivo en YouTube. Pero también todavía vamos a tener nuestras reuniones de español en los jueves en vivo. And then finally, because I will not be here to join you guys for the live webinars, if you do have any questions and you can't get an answer in chat, or if you're watching the recordings and you have any questions, please always email me at support@sectorsmadesimple.com. I want to thank you all so much for joining me for this very detailed introduction of the asset class cycle, but I hope that you've gotten a better idea of what this whole crazy idea is, so that over the next 3 webinars, we can dive into each one in more detail, share with you how we can invest in many of them directly, and many of them through other types of investments that we're more familiar with, such as ETFs. But thank you all so much again for joining me. It's an absolute pleasure, and I will see you guys all in a few weeks. Take care.